Understanding liquidity in day trading is the most important part of technical analysis out there. So today we're going to do a full A to Z on liquidity and how to actually use it and implement it into your trading. Let's get into it. All right, guys, before we get into how we can actually utilize liquidity to make money in the markets, we need to have a basic level of understanding of what liquidity actually is before we can implement it. So within the markets, there are certain price points where there is liquidity. And what does liquidity mean? It basically means a certain area of the market where a lot of buying and selling is happening, okay? So one thing you have to understand about trades is for you to buy something, somebody else has to sell it to you, okay? And vice versa, right? So there are certain areas in the markets where a lot of money is coming in and out and a lot of orders are being filled, and that is basically what's known as liquidity. Now, why is that relevant, right? So people like us, retail traders, we do not have problems finding somebody to sell their position to us if we want to buy because our money is so small. However, the people that move these markets, right, the banks, the institutions, they are putting in huge orders, and that's what actually causes the market to move. But for them to be able to actually place an order, they need a lot of people to sell to them. So that's why the institutions will target areas of liquidity so their massive positions can get filled so they can move the market in the opposite direction, okay? That's pretty much the fundamentals of it. You can go much deeper if you want, but if you want to actually make money from it, you don't need to know all of the ins and outs. What you do need to understand is, in simple terms, is that liquidity in the market basically means there is a lot of buying and selling going on in these particular markets, and the institutions will target those areas so their orders can get filled so they can push the market in the opposite direction. That is what liquidity is, and the reason we use it to make money is who wins in this market? It's the institutions and the banks, and the retail traders are the ones that lose for the majority. So our goal is to be able to identify what is happening in the markets in terms of what the banks want to do with the market. So if we can see that, let's say the banks want to take the market down to a certain point so they can fill their buy orders to then push the market up. If we can see this happening, we can basically jump on the back of the bank's orders and catch a huge move. All right, guys, so how does the market normally move? All right, so we have uptrends and we have downtrends. So basically an uptrend is made up of a high, a low, and then a higher high, higher low, higher high, higher low, and it's the same for a downtrend. Lower high, lower low, lower high, lower low. You get the point. Now, as a retail trader, where do you normally look to take a trade? Okay, so example number one, you have a high here, right? Let's say price breaks above this high, okay? A typical retail trader will want to then enter a buy right here. Okay, it's broken this resistance, it's gonna go long. So they will be placing buy orders right here, and maybe they will put their stop loss just at this low, okay? So what we can take from this is at each high or low, there is some amount of resting liquidities, which is buy orders and sell orders, stop losses and take profits, okay? Where buying and selling takes place, right? So with these areas, this is potentially where banks could target to take that liquidity and move the market in the opposite direction, okay? So long story short, liquidity is usually found just below the lows and just above the highs, okay? And this is where banks will be able to fill their orders, like I said, because there's going to be a lot of buying and selling here, and that is literally what liquidity is and how it works. All right, let me simplify that once more so it really gets in your head, okay? So market's moving up, okay? So majority of traders are going long. They see it's pushing up, they're going to go long, and they're going to put their stop loss usually at this low, okay? And then you've got the other traders that if they see a break below this support, they are going to go short, okay? So right here. So what do we have right here? I know this seems complicated, but it's actually quite simple. What do we have right here? Well, we have two things. Number one, the people that bought shares to go long are going to have to sell their shares down here at a cheaper price to somebody else who wants to buy, okay? And what is happening with these short sellers? Well, they are selling shares, meaning somebody else is buying, okay? So right here, there is a lot of resting liquidity that if the banks wanted to push the market up, they could. So what is a liquidity sweep and how do the banks actually fill their orders? What does that look like? I'll just use the same level. So we see our uptrend, okay? And then at this point, if the banks want to continue to push the market up, they can come all the way back down here. And now, once they pass this point, all of the people that went long have to now sell their shares at a cheaper price to somebody who wants to buy. And then there's going to be a bunch of people that have just entered in short, meaning somebody else bought their stock or whatever at a cheaper price. So they've faked everyone out. Everyone who was going long got stopped out, and a bunch of people have just gone short. And then what does the market do? Bang, the market reverses, okay? That is how the banks work. That is how they use retail traders and points of liquidity to get a cheaper price to push the market up. And obviously, same goes for the opposite way around. So let's just look at a basic example of this happening in the markets. It's very easy to spot, but let's go back to a time that we all remember in early 2020. Now, I'm not going to get too much into this, but what can we see here? We can see that the market is in a clear uptrend, okay? We've got higher highs, we've got higher lows. We've got higher highs, we have a lower low, higher high. Overall, it's in an uptrend. And then what do we see? We see an absolutely massive crash, okay? So for all those people that were long, what happens? Let's say they bought here and they said, right, I'm going to put my stop loss just here because I think the market's going to go up. And then you have the other guys who said, if price goes below here, I'm shorting. So they see this huge sell off. They say, holy shit, the market's going down. They're going to put a sell order right here. And then what happens? All of the people that were long get out of their position. They have to sell their shares at a cheaper price to somebody else. And the people that want to go short are also selling shares to the banks or whoever you want to call it, right? So as you can see right here, this was a strong point of liquidity right here. Liquidity was taken out and then the market continues to move in the opposite direction. All right, one last diagram and then we'll hop onto the chart. So what are we looking for here? We're looking for higher highs and higher lows until a lower low is made, and then we will see price skyrocket in the same direction. So basically all this does is tricks everyone into thinking the market is going down, and then it reverses on everyone. That's why as a retail trader or a beginner trader, it seems like your stop loss always gets hit and then immediately reverses in the other direction. We all know that feeling, and it's probably the fact that you are the liquidity in the market, and that's why most retail traders consistently lose, okay? Same for shorts. We have lower highs, lower lows, lower highs, lower lows, and then we have a higher high being printed, indicating a change of direction. People think the market's going to go up, but it's actually the banks taking liquidity to push the market down even further, okay? So let me just literally zoom out, and we can see this on any time frame. It doesn't matter if it's the 1 minute or the weekly, okay? We can always see it happening. So if we just zoom in, let's look. So we've got higher highs, higher lows, higher highs, higher lows. Okay, bang, there's one. Simple. So we can see that market was in a nice uptrend. Obviously, yes, there's smaller liquidity grabs within this. I'm just going to focus on the more obvious ones. So we were in an uptrend. Price then made a lower low. People are now thinking, okay, it's going to go short, so they're going to sell. Those that were long are going to get their stop losses hit, and then price smashes upward once again. Once again, market is making higher highs and higher lows, and then all of a sudden it creates a lower low and immediately reverses. This is what we're looking for. Now, obviously, just because it makes, its first lower high or lower low, it doesn't mean necessarily that it's going to be a liquidity grab, and it doesn't mean necessarily that we're going to immediately enter a trade, okay? Liquidity is not a strategy. It is one aspect of a strategy that you can use to, to determine the direction, right? But you got to have confirmation. There's going to be other elements that you look for before you actually enter a trade, but liquidity is the foundation of my style of trading anyways. So we don't just use liquidity for an entry, we also use liquidity for an exit, because now we understand that liquidity acts as a magnet, because that's where the banks can fill their next orders, okay? So just one more example. Again, this is not a full strategy or anything. This is not all you need. There's a lot more that goes into it, but it can still be used to your advantage, okay? So as we can see, market's clearly in an uptrend. We then see a clear sweep of liquidity right here, and we don't just immediately enter. We need some sort of confirmation. I'm not going to go into it too much in this video, but you can see that there was a fair value gap printed here. Price then pulled back, tagged us in our fair value gap, and then we go short. And where do we target? Well, you got to imagine that the market hasn't moved here yet. We would target the resting liquidity, okay? We would target right here because it acts as a magnet. So just as an example, let's say we enter our trade here when the fair value gap was filled. We'd put our stop loss just above this high, and we would aim for the resting liquidity for a 1 to 3.5. Okay, that's how you can use liquidity. But again, this is one small element of a much bigger picture, but it's extremely useful. And if you can start to see where liquidity lies in the market, it's no longer just a guessing game, okay? Once again, guys, this applies to every time frame, every pair, every crypto. It's all the exact same, okay? So just looking at the markets, where is liquidity? We can see liquidity sweeps happening everywhere. So we have this very prominent high right here, and we can see that price is a magnet to this liquidity. It then sweeps it, and then it goes down, right? We can see liquidity sweeps everywhere. You can see these prominent lows here. Price literally just faked everyone out and then immediately reversed to the next major liquidity zone, okay? So that's why the market is always moving back and forth, okay? When liquidity is not being swept, the market might be choppy. So like down here, nothing really major was happening. We were just kind of going sideways. As soon as a major level was taken out, that's when the big move happened, okay? So when liquidity is successfully swept, usually what follows is a pretty strong move to the next resting liquidity. So again, we can see this all the time, right? Again, here, it's not incredibly major, but again, this works on every time frame. So if you were to drop this down to the 5 minute, you could find trades here. So as you can see, we were in a downtrend. Price then came up, pushed above the previous high, and then immediately went down. And we'd followed that by, once again, another one, right? So prominent low, price swept liquidity and pushed to the upside. Happens all the time, guys. Once again, huge liquidity grab. Price is clearly going up. This fakes a bunch of people out, makes people go short, hit stop losses, and then price continues up. And once again, another prominent low, swept, and then straight to the upside. Guys, this is like, look, I actually took some trades on this. So as you can see here, we're still in an uptrend. We had some prominent lows. We saw clear sweep of liquidity. I waited for some confirmation and I took my trade. All right, guys, that's it for this video. I might make more videos going a little bit more in depth, but it's very hard to explain liquidity in like a 10-minute video. So I hope you got some value from that. We're doing a lot more of this kind of stuff inside the free Discord, which I will leave in the description. But yeah, if you like that, drop a subscribe and I will see you guys in the next video.